Next up, we have Chris Kuiper. He is the Director of Research for Fidelity Digital Assets, which provides enterprise-grade digital asset solutions for institutional investors. Chris contributes to and oversees the research creation process to provide leading Bitcoin education and resources to clients. Welcome, Chris.
All right, thank you, everyone. Thank you for being here. Thank you to Strategy for inviting me. It is a pleasure and honor to be here today. One of the things I do at Fidelity Digital Assets on the research side is I talk to a lot of institutional investors. So money managers, fund managers, advisors, and I try to speak in their language, making the investment case for Bitcoin. So that's what I want to try to do this morning. I want to take that, but tailor it to corporations and specifically talk to corporations. To be clear, I think that you have to have the philosophical understanding and conviction in Bitcoin. You have to have the fundamentals, a lot of the stuff that Alex just talked about. But it helps to add another leg to that investment thesis stool, the investment angle. And so let's jump in right into the numbers here. I'm going to put on my CFA hat, my nerdy analyst glasses here. This is a chart that I show a lot of institutional investors. This is, broadly speaking, their menu of options if they're running a fund or running money. You see they've got stocks, fixed income, real assets, and then you've got your first two columns are your return. Your second two columns are what they consider to be risk. I'm going to talk a little bit about that in a second, though. And then the last two, bring those two together, risk versus return. So not surprising for a lot of people here, Bitcoin 79% annual, compound annual growth rate over the last 10 years. Now you might say 10 years, well that includes a pretty fantastic early period for Bitcoin, you would be right. But if you take the last 5 years, it's still very high, around 65%. So I'm not trying to cherry pick here. I'd rather have the 10-year picture for you here for the other things. So for example, corporations, as Alex said, they're not buying stocks. Real assets are hard. Gold, commodities, real estate, they're hard to buy, they're hard to purchase, they're hard to insure, transport. They're literally boxed in that middle box. Treasuries, maybe they can go out on the duration curve with intermediate treasuries, investment grade corporate bonds. But you see, over the last 10 years, they've only gotten about 1.3% out of those. And that's nominal. We're going to get to real in just a second, real returns. Now, of course, the reason for this is they like the low risk, the low perceived risk. Low standard deviation, not too much of a drawdown there. But if you put the two together, which is what a good analyst should do, what return are you getting for the risk you're taking on? The Sharpe Ratio shows a different story. So Sharpe Ratio, as you know, is your excess return, return minus your risk-free rate, divided by that risk measure, standard deviation. The Sortino Ratio might be a little more interesting, especially for corporations, because this takes your excess return and divides it only by the downside standard deviation. So in other words, most people don't care if Bitcoin is volatile on the way up, it's ripping higher. They care when it's crashing and going down. And I'll get to that in just a second as well. So here's your return, risk versus return. The other thing they always look at is correlation. So on the left chart there, you see the correlation of Bitcoin to major asset classes. Most people are surprised it's this low, but this is over a longer time period. At some time periods, it is very high, especially to things like stocks. But if you take a longer term view, low correlation even to things like commodities, gold, real estate, other real assets. The chart on the right is what I think is more interesting. This is very underappreciated, in my opinion, both in the Bitcoin community and certainly in the investment community. This is a histogram showing the monthly returns for the S&P 500 in blue, and then Bitcoin in orange, of course. So the S&P 500 looks like a pretty normal distribution. So on any given month, the S&P is going to go up 1% or 2%. Maybe it'll go down 1% or 2%. Bitcoin, of course, is completely inverted. It's flipped inside out. Any given month for Bitcoin, you're not going to go up or down 1% or 2%. You're going to go up a lot, or you're going to go down a lot. And this obviously talks a little bit about the correlation. So this is why it's uncorrelated. And that's, of course, the holy grail in finance. Find an uncorrelated asset to add to your mix. You can improve your risk-adjusted returns. William Sharpe of the Sharpe Ratio that you just saw, he is thought to have said, I can't prove this anywhere, but everyone agrees at one point he said, there's no free lunch in finance except for diversification, or diversification is the only free lunch. So that's one reason why this is interesting. But more importantly, the distribution is skewed to the right. at least historically, meaning there's more times when Bitcoin has gone up than it's gone down. And this makes it very different from every other asset class out there. So if you've heard of good cholesterol versus bad cholesterol, not all cholesterol is the same, LDL, HDL, good versus bad. You want the good cholesterol in your body, you don't want the bad cholesterol. Bitcoin has more good volatility than bad volatility. And this makes it unique because, for one, you can actually harvest that volatility. If you do a quarterly, monthly, annual rebalancing, whatever it is, Bitcoin goes up, you rebalance back to your target rate, you're harvesting that volatility. The other reason this makes this so unique, and this is what I think is quite profound, is that it turns on its head a lot of traditional finance, which says volatility equals risk. The pure definition in finance is things like standard deviation. But that's because most assets have that normal distribution. Or they even have, you can even see in this chart here, there's a little bit of a spike in the blue to the left there. So if you heard the old Wall Street adage, stocks take the escalators up, the elevator down, that's because that volatility comes at times of crashes. And that's why they think of volatility as risk. Risk is not volatility, though. Volatility, the other side of it, is opportunity. True risk, in my opinion, is permanent loss of capital. And of course, I'm not the first to say this. I think even Warren Buffett, who hates Bitcoin, has said this before. So risk is not volatility, it's permanent loss of capital. So for corporations, the permanent loss of capital they should be concerned about is this. You've seen this chart before, the purchasing power of the US dollar. This is used with CPI numbers. Notice on the left, I've done a log base 2, logarithmic base 2. So every horizontal grid line you see there is the dollar getting cut in half. So you can see the half-life of the dollar is a decade, maybe 2, if it's doing okay. And so this is the problem that everyone faces on an individual level and certainly a corporate level. You say, well, that's fine, but I'm a corporation. I don't put cash in a vault. I don't stick it under a mattress. I invest it. So here's cumulative returns of a 3-month Treasury bill, $100 to what it is to today. So you've done a little better. Nominal returns for bonds, 10-year bonds, you can do even a little bit better still. But of course, that's nominal. If you look at real returns, the 3-month T-bill, you've barely tread water. And with Treasuries, you've done a little bit better as interest rates have come down and inflation has come down as well from the 70s and 80s. This next chart here, I saw a version of it, and I didn't actually believe it when I first saw it. A lost century in 10-year Treasuries. Meaning if you held a 10-year Treasury for 100 years, after your real return, after inflation, and after tax, you have made no progress. So I actually calculated these numbers myself to verify it. Don't trust, verify, right? And it's worse than I thought. So I've used the statutory tax rate historically for corporations here. So maybe tax rates are around 21% right now for corporations. They've been as high as 50% or more. So as you see with the recent bout of inflation, you are, again, underwater after almost 100 years. And the question, of course, is, do you think tax rates for corporations will stay at 21%? Do you think inflation will stay where it is today? Do you think interest rates have a lot more room to go lower and bond prices higher? Maybe, maybe not. A lot of corporations say, okay, I'm convinced. I've got to protect my purchasing power. This is a real threat, especially maybe in today's macro environment. But the thing that scares them the most is this. They look at these massive drawdowns in Bitcoin. And to be clear, we have to recognize this. 70 to 80% drawdowns are nothing to sneeze at. So let's acknowledge that up front. But one thing I want to point to is notice the time period here. Every drawdown lasts maybe 3 years or so. But this is why they go into things like 10-year Treasury bonds or even shorter. They see these nice, shallow, nominal drawdowns. Very short, very shallow, although recently, minus 20%. But again, the bigger threat to a corporation, especially if you plan to be around for a long time, is your real return. This is effectively the drawdown you're experiencing because you have to use your money to purchase things. And so even bonds have experienced a 55% drawdown on an inflation-adjusted basis. And notice it wasn't just 3 or 4 years of a drawdown, it was 40 years of a drawdown that they sat in that underwater. I just saw a statistic this week. The US aggregate bond index, so the Bloomberg US aggregate bond index, is in its 57th year of a drawdown, the longest it has ever been in its history. And it's still going on since the year 2000. So again, this is what Bitcoin is designed to protect against, in my opinion. In our research, we find Bitcoin is driven by two major macro factors. Number one, currency debasement, which we're showing here with the global broad money supply change year over year. Notice there are two different axes, so Bitcoin has massively outperformed that debasement. And then inflation expectations, not CPI, which is backwards looking, but if you look at when inflation expectations actually spike, that's when Bitcoin is spiking as well. And so this is what it's designed to do. If you look at this data on this chart, it actually has an R squared of 0.8 to 0.9. That means that 80 to 90% of Bitcoin's move can be explained by the change in the money supply. All right, so even after saying all that to a lot of corporations, I still hear from them, I got to protect my purchasing powers, but I just can't handle that volatility. I've got bills to pay, I've got intermediate bills to pay, I've got intermediate opportunities to pursue, and I certainly can't have a 80% drawdown at a time when it's probably going to be pretty bad for the rest of the environment as well. Again, that elevator, that crash there. So I'll offer two simple ways to mitigate this volatility. Number one is just the power of position sizing. In the green, you see the current option set for someone like a corporate treasury. They can be in T-bills, cash-like instruments. There's no max drawdown there. There's no drawdown at all. But of course, they're not keeping up with inflation, minus 1.2% over the last 10 years. It's actually worse if they go out on the duration curve with 10 years, at least it has been over the last 10 years. And then, of course, you have Bitcoin, but they can't stomach the 75 to 80% drawdown. But Bitcoin, like a lot of things in finance, is not an either or. It doesn't have to be. It doesn't have to be 100% in or 0% out. It's not a switch. It's more like a dial. So you can think about adjusting an analog dial. You can move your exposure up or down depending on your risk tolerance, depending on your situation. And so here in the orange columns, you see just some hypothetical examples. These are not recommendations necessarily. But the cash part is just 3-month treasury bills. It assumes annual rebalancing. It assumes reinvestment of dividends. And you can see by blending in different levels of Bitcoin, you can greatly increase your returns, at least historically you would have. Your risk in terms of standard deviation, that classic measure, does go up. But what you're mostly concerned about is that max drawdown. And you can dial this up to what you think your company could handle. And then to throw another ratio at you here, we talked about the Sharpe Ratio, the Sortino Ratio. There's also the Calmer Ratio. And that is your excess return divided by your maximum drawdown. And this is very important for companies like banks who have certain capital requirements, or any corporation that just says, I need X amount of cash. I can never go below this line. And so you can see the Calmer Ratio for different levels there, and you can, again, dial this up or down to what suits you. So that's one way to handle it. The second way to handle it is just have a longer time frame. This is Bitcoin's compound annual growth rate over various periods, rolling periods. So you've got rolling 4-year CAGR, rolling 5-year, rolling 7-year, rolling 10-year. And you can see the worst that has ever happened, at least historically, is that 5-year CAGR. At one point, you barely hit zero, maybe dipped it below it for just a few days or weeks. But if you have a long enough time period, it's all of these have been positive on a rolling basis. So again, if you don't need cash as a company for the next 4, 5, 7 years, you can ride it out. You can wait out the drawdown. You can wait out the volatility. But this goes back to my first point. It's why you have to have the conviction as well. All right, this is my favorite part. I started my career as an investment analyst. It's what I did mostly before coming to Fidelity. And early on in my career, I listened to hundreds, if not thousands, of corporate earnings calls. And it became clear to me right away that corporations and Wall Street focuses almost exclusively on the income statement, not the balance sheet. So it's all about revenues. What was your revenue growth? Did you hit your target? What were your expenses, your margins, and then that big EPS number? Did you hit it? Did you exceed it? What did you guide to? You guys know this game. But as I tried to be a better analyst and I started reading a lot of books, some of the better analysts out there, they all said the same thing. Start with the balance sheet to understand a company. And then my mind was really blown. My eyes were literally opened when I came across Michael Mauboussin. I don't know if any of you've heard of him, but he's a great thinker. He's a professor of finance. He's worked in the industry many, many years. He's an author of multiple books. And the book that really opened my mind was one called Expectations Investing. And there's a lot in this book that I won't get to, but the big part about it is he introduces return on invested capital. And this is not unique to him, but he's the one that put it in terms that took out a lot of the noise. So if you're not familiar with return on invested capital, it's simply this. You take your income statement, you want to get your cash earnings, so NOPAT is net operating profit after taxes, and then you divide that by your invested capital, and that comes from your balance sheet. So it is explicitly linking the income statement to the balance sheet in one metric. If you're wondering what the invested capital is, just a side note, you can compute it top down or bottom up. If you're going from the bottom up, it's simply your net working capital plus all your property, plant, and equipment, your acquired intangibles, and your goodwill. So basically all the stuff you need to operate your business. So if you take the cash earnings divided by your capital base, you get return on invested capital. Now this number doesn't mean a whole lot just by itself. You can see trends if it's going up or if it's going down for a company. But where it really comes into play is when you compare a company's cost of cap or return on invested capital to its cost of capital. So if it's returning more than its cost of capital, you're creating shareholder value. Less, you're destroying shareholder value. Now, where the insight came from with Malbus and others is that you can decompose this, you can see what's driving it, but most of all, it strips out the noise of the income statement. It strips out the noise of all the things you hear on financial television and analysts and what they're saying. Because, for example, a company could be growing its earnings very quickly. But if it's growing its invested capital base to get that earnings growth or that revenue growth, it could be destroying capital. And you wouldn't know it just by looking at the income statement. And the research shows, and the academic research shows, that the market eventually figures this out and it will punish a company accordingly through its stock price. And the reverse is also true. You could have a company that's shrinking its capital base, its revenues might actually be declining, and you think it's a dying company, but they're actually increasing the returns on invested capital. They might be divesting business lines that don't make sense anymore, are low return, they take up way too much capital, and the market rewards them as well. So you might be wondering, what does a typical company look like? So here's the 5-year average return on invested capital for the S&P 500. Most of them, as you can see, are in that left tail. They're all bunched around 0 to 5, 5 to 10, 10 to 15%. Pretty moderate to mediocre returns. And mind you, this is for the S&P 500, the cream of the crop. And there's, of course, a few way out on the tail, companies that you probably would surely recognize that have outstanding returns. The other interesting thing about this is there's a debate in the investment community of how to handle excess cash. Michael Malbus and others say you should strip it out, don't include it. Why? Because you're trying to get at a measure of how economically efficient a company is. How does it compare to its peers? So if you're trying to do that, I would agree with it. However, I'm in the other side of the camp where I think you should include it if you're trying to evaluate how good management is allocating capital. Cash is something that management has the discretion to allocate, and one of their #1 jobs is to be a capital allocator. So we should include it, and this is becoming a big deal. As you can see, S&P 500 companies, cash as a percent of revenues. From the early 90s, it's gone from 10 all the way up to 35% today. You can see we came down a little bit from the COVID era where they were hoarding a lot of cash. And this even goes back earlier to the 70s and 80s. The two biggest drivers to this, better inventory management. So think of like just-in-time inventory, a more globalized world. And the other one is just the digital nature that all of these companies live in today. You can now run a multi-trillion-dollar company with very little capital. It's code, it's software, it's servers. It's not heavy equipment, railroads, industry, that sort of thing. So those are the two big trends there. And to give you an idea of how big of a difference this makes in a company's returns, if you take Microsoft, just as an example, at one point they were earning 49% return on invested capital. That is extremely high, as you saw with that histogram. That tells you how good of a business that is. Incredibly high margins, incredibly capital light, efficient, and lean. If, though, you add in their excess cash, that 49% goes down to 29%. So that tells you how much of a drag this extra capital, this extra cash is on their returns. That's just sitting there, not earning as much as their cost of capital. So here's my last slide and my question to companies today. Is your company generating shareholder value? Here's a summary of that histogram you saw for the S&P 500. The average S&P 500 company returns about 12% on their capital. The median's a little lower, around 11%, but they still have a positive spread. They are above their cost of capital around 8%. If you zoom out and you cast a wider net, the Russell 3000, the median Russell 3000 company is only earning mid to high single-digit return on invested capital. The average is much lower. That tells you how much is being driven by these outliers. And of course, they have a negative spread. They're not earning their cost of capital. They are, on average, destroying shareholder value. And then you compare this to Bitcoin. Average annual return last 5 years, 65%. So the question to companies out there is, number one, what's your return on invested capital? Have you calculated it? How does that compare to your cost of capital? Are you generating shareholder value? Do you have extra cash? And if so, what are you doing with that extra cash? And then the ultimate question is, what's your current opportunity set? What are the investment ideas and opportunities that are in front of you? And do you think or do you believe the return on those ideas or opportunities will exceed the opportunity cost of Bitcoin? Thank you.